Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you with our weekly wrap-up. Graham, I understand we ended the week on a positive note last week. What can you tell us about
it? We did, despite rising interest rates, right? And that's been putting a lot of pressure on equity performance, at least in stock market performance, because of these rising rates. So, yeah, I think we broke a 5-6 week trend in the market of downtrends in the indices. So we did see some strength. The Nasdaq was up about 2.5%. We have the S&P and the Russell 2000, remember, is a small cap index. They edged up about 2% last week. So we had 9 of the 11 S&P sectors in higher last week, really led by basic materials, industrials. We also saw crude oil and gold post some pretty solid gains last week as well. Still saw a suddenly strong labor market in terms of strength. Globally, inflation is still persistent. We'll get into those numbers in just a minute. And still saw jobless claims remain below 200,000 for the 7th straight week. U.S. manufacturing did contract a bit in February as prices paid did tick up a bit. The ISM Services Index continued to expand at a pretty strong, robust pace. Recession fears still to be bubbling up in conversations with the markets. So I think we still have consumer confidence maybe worsening a little bit as those reflation fears are there. The biggest concern that we really saw last week is interest rates moving up, the fear that the Fed's going to have to keep rates higher for longer, and are they going to have to raise a bit more to tamp down some of these higher inflationary indicators that we're starting to see. Overseas, we saw China come out in their February factory activity, and that was some good, strong, or predicted good, strong global growth in 2023. It looks like they're expecting somewhere around a 5% GDP over in China. In Europe, listen, they're stronger, right? I think the winter wasn't as cold. That took the pressure off of cost. But that being said, CPI still stayed at a really high rate, about 8.5%. So the likelihood that their central banks can kind of sit back and coast a little bit because inflation's coming down might not be so much compared to the United States Federal Reserve. So they're probably still likely to raise interest rates 50 basis points plus. Ours are still, about 25 basis points, as long as we're seeing effort being made bringing down inflation.
All right. Well, with the market having started off on a positive note for the year, do you think that's something that will continue?
I sure hope so, right? Last year was such a challenging year in the markets, and that's probably an understatement. Certainly looking at sector by sector, some were just absolutely pummeled. So I think we can eke out a better year. That's, as we've said all along with our clients and on different calls, is that it's probably a show me year. Show me that the Fed can slow the pace of tightening. Show me that inflation's coming down. Show me that we're not going to go into a deep protracted recession. It may be a light one that emerges towards the end of the year, first of 2024. But that doesn't mean the market still can't advance through that as we move through the cycle. So I think the market's got room to move higher. I don't know if we're going to set new highs. I think that might be a bit ambitious, but I think we can go a bit higher from where we've pulled back from this level.
Okay. Well, with interest rates being high, like you've mentioned, does that present any opportunities for investors that may not have been here last year?
It absolutely does. Over the previous years, really stock's been the only game in town. You really couldn't get paid to be in money markets or CDs and these really ultra safe return of your money type vehicles. Well, now you can. I mean, you got money market rates and money fund rates. I know at least over here at about 4.5%. And as the Fed raises rates, that's only going to go up, right? Just keep in mind as they plateau and hopefully one day the Fed might lower rates, right? Those things are going to come down, but it presents opportunities. Bonds had the worst performance they've had, I think, in history last year. So I think you have capital appreciation opportunity and incredibly strong income yields or yields on those products. So I think it does expand where you need to be considering placing your safe money, your intermediate, your long-term money. You have options, long story short.
Okay. Well, thank you so much, Graham. And I
Yeah.
do want to share with our viewers just a couple quick reminders. As you know, we always say here at Wickham Financial and Insurance Services that we lead with education, and we are really sticking to that this week and next week as we present our next session of retirement planning today. Classes starting tomorrow evening, and also have a Saturday session. And those are multi-day classes. So it's 2 days for 3 hours each class. And it's really A to Z, all that you need to know about preparing for your retirement. We do have some spots still available. So please give us a call here at our office and we'll be glad to give you the details and get you signed up for class. Also, next week, we have a workshop that we're presenting here at our office classroom, and it's going to be presented by Graham and our insurance team. For those of you who may be business owners or you're thinking about starting a business, from an investment and an insurance standpoint, we're going to discuss some things that you may need to consider as you begin those steps to owning your own business. So again, we'll be happy to provide you with more details on that if you just give us a call, and we'll also have it on our website as well. So we hope you have a great week. Thank you for joining us today. We'll look forward to seeing you again next week for the weekly wrap up.
Take care.